I need you to stop scrolling and listen carefully because this is not hype, this is not speculation, and this is not optional. What I'm about to explain is going to affect every single person who owns crypto, XRP, Bitcoin, Ethereum, NFTs, stablecoins. It does not matter what you hold. Starting January 1st, a new reporting requirement kicks in that is based on everything you did in 2025, and most people are completely unprepared for it. This is one of those moments where the damage doesn't happen in real time. The damage shows up later, quietly, when people open a document and realize they owe far more money than they ever expected. And by the time most people realize what went wrong, it's already too late. The issue is a brand new IRS form called 1099-DA. This is not a rumor. This is not a proposal. This is real. Centralized crypto exchanges are required to issue this form, and here's the part nobody is warning you about. The data on these forms is often wrong. Not slightly wrong, but fundamentally misleading. A lot of people assume if Coinbase or another exchange sends the IRS a form, it must be accurate. That assumption is going to cost people thousands, sometimes tens of thousands of dollars, because the way these exchanges currently track transactions does not properly distinguish between a sale and a transfer. Let me say that again slowly. If you moved crypto from an exchange to a cold wallet, many platforms will treat that movement as a taxable event. That means if you bought an asset at one price, transferred it when the price was higher, the system can flag it as a gain, and even though you never sold anything. That's not a joke. That's how a lot of the current back-end systems work. Now think about the scale of this. Millions of people moving crypto between wallets, years of activity, and suddenly in early 2026, people are going to receive a document saying they made far more money than they actually did. Panic will set in, CPAs will shrug, and the IRS will see a number on paper that doesn't reflect reality. Most people don't realize this yet because it hasn't hit them in the face, but it's coming. And here's another uncomfortable truth. Most tax professionals are not equipped to handle this. Many CPAs, enrolled agents, and off-the-shelf tax software platforms do not understand blockchain transactions at a granular level. They rely on third-party forms. If the form says you made money, they assume it's correct. That's how people end up overpaying taxes, legally, quietly, and permanently. This is not about avoiding taxes. This is about not paying tax on money you never actually earned. Now, here's where this gets dangerous for a lot of people, and I want you to really slow down and listen to this part carefully because this is where most mistakes will happen. The biggest issue with the new 1099-DA isn't that it exists. It's how exchanges are going to report your activity and how blindly most people trust that data. Centralized exchanges like Coinbase, Gemini, Crypto.com, PayPal, Robinhood, all of them are classified as brokers under this rule. That means they are legally required to send transaction data directly to the IRS. And here's the catch. For the 2025 tax year, they are only required to report gross proceeds, not your cost basis. That means the form will show how much crypto you supposedly sold or exchanged, but it will not correctly show what you paid for it. And here's where things get ugly. If you move crypto from an exchange to a cold wallet, many exchanges will classify that movement as a taxable disposal. If the price is higher at the time you moved it than when you bought it, their system can flag that as a gain, even though you never sold anything and never realized profit. This isn't hypothetical. This is already happening inside exchange dashboards right now. So imagine opening your tax documents in early 2026 and seeing a number that says you made 2, 3, or even 5 times more than you actually did. Most people will panic, and most people will do the worst possible thing. They'll hand that document to a CPA who doesn't understand crypto and say, just file this. And that's how people overpay thousands, sometimes tens of thousands in tax they never owed. Here's another uncomfortable truth. Most CPAs and tax software platforms are completely unprepared for this. H&R Block, TurboTax, generic local accountants. They rely on third-party forms. If a form comes from Coinbase, they assume it's correct. They don't reconcile wallets. They don't adjust for transfers. They don't track cost basis across chains. Crypto breaks the old tax model, and the IRS knows that. This is why the IRS is rolling this out in stages. First, gross proceeds. Then, starting in 2026 tax years, cost basis reporting will be added, but only for assets acquired after 2025 and only if they were held with custodial brokers. Anything before that, that burden falls on you. So if you've been active in crypto for years, moving assets, bridging, swapping, self-custody, DeFi, you are responsible for proving what actually happened. The exchange will not do that for you. The IRS will not assume you're right, and ignorance will not protect you. This is why specialized crypto tax tracking matters, not plug it in and hope it works software, but tools that let you reclassify transfers, reconcile wallets, correct mislabeled disposals, and actually reflect reality. The people who ignore this will learn the hard way. The people who prepare now will avoid the stress entirely. Now here's the part that should genuinely make you stop and pay attention, because this is where most people are going to get blindsided if they don't understand what's coming. For the 2025 tax year, brokers are not required to report your cost basis. Let that sink in for a second. That means when these 1099 DA forms go out in early 2026, what many of you are going to see is a document showing gross proceeds only. In plain English, it's going to look like you made a fortune even if you didn't. Transfers, wallet movements, consolidations, even internal reshuffling of assets can all be misclassified if the exchange doesn't have full visibility of your activity across wallets and platforms. So imagine this scenario. You bought XRP at a lower price, transferred it off an exchange to cold storage when the price was higher, maybe moved it again later. On paper, the exchange's system may interpret that as a sale. No cash was received, no profit was realized, but the form may still show a taxable event with a gain attached to it. And if you blindly hand that form to a CPA who doesn't understand crypto, they will file it exactly as written. This is where the real danger is. Not audits, not fines, overpayment. The IRS doesn't need to accuse you of anything when you voluntarily report inflated gains. You are essentially doing their job for them, and a lot of people are going to do exactly that out of fear, confusion, or blind trust in third-party forms. Another hard truth you need to hear is this: most CPAs are not prepared for this. Traditional tax professionals are trained on stocks, bonds, W-2s, and 1099 INTs. Crypto introduces on-chain transfers, self-custody, wrapped assets, bridges, multiple cost bases, and wallet-to-wallet movement. If your CPA's entire crypto knowledge starts and ends with "just give me the Coinbase form," you are exposed. And it's not because they're bad people, it's because this reporting framework is brand new. The rules are evolving. The software is inconsistent. Some tools capture nearly everything correctly. Others miss a significant percentage of transactions or mislabel them. Two people using two different platforms can end up with wildly different tax outcomes from the exact same trading behavior. This is why you cannot treat 2025 like any prior year. The reporting regime is changing. The assumptions that the exchange will handle it or the IRS will figure it out are no longer safe. Responsibility is shifting directly onto you. And to be very clear, this is not about avoiding taxes. This is about paying what you legally owe and not a dollar more. There is a massive difference between tax evasion and tax accuracy, and too many people confuse the two. Accuracy protects you. Ignorance costs you. Now, here's the part that really catches people off guard. And this is where a lot of damage is going to be done if you're not paying attention. Starting with the 2025 tax year, exchanges are only required to report gross proceeds, not your cost basis. That sounds harmless until you understand what it actually means in practice. Gross proceeds means the total value of transactions the exchange believes were sales or disposals. It does not automatically mean profit. It does not mean gains. It simply means movement of value, and that distinction is where things get dangerous. If an exchange mislabels a transfer as a sale, the IRS form will reflect it as taxable income, even if no sale ever occurred. So imagine this scenario, because it's going to happen to a lot of people. You bought XRP at a lower price earlier in the year. Later, the price is higher, and you move that XRP from an exchange to a cold wallet for security. No sale, no profit realized, no cash received, but the exchange's system flags that movement as a disposal. The 1099 DA shows gross proceeds at the higher price. On paper, it now looks like you made money, even though you didn't. When that form gets sent to the IRS, the burden is no longer on the exchange. It's on you to prove that it wasn't a sale. If you don't correct it, the IRS assumes the number's accurate. That's how people end up paying tax on gains that never existed. And this is why blindly handing a CPA a Coinbase or Gemini statement is a mistake. Most tax professionals are trained to trust third-party reporting. If they see a 1099, they assume it's correct. They don't question whether a transaction was a transfer, a swap, a bridge, or internal movement. They just plug the numbers in and move on. This is also why standard tax software struggles with crypto. Many platforms miss transactions, double count movements, or misclassify activity across chains and wallets. Some capture 100% of activity, others miss 10%, 20%, even more. That inconsistency alone should tell you this is not something you want to ignore. The uncomfortable truth is this: you are now responsible for reconciling your own crypto history. If you don't, the default assumption will be that the exchange is right and you're wrong. And once that happens, fixing it later becomes far more difficult. This isn't about fear, it's about preparation. This is the first year crypto is being pulled fully into traditional tax reporting frameworks, and transitions like this are always messy. The people who take time to understand what's being reported, how it's classified, and how to correct errors will be fine. The people who ignore it and hope it works itself out are the ones who will panic when the forms arrive. Now let's close this out clearly and responsibly, because this is where a lot of people either protect themselves or get blindsided. The most dangerous mistake you can make with this new 1099 DA situation is assuming the exchange did it, so it must be right. That assumption is going to cost people real money. These forms are designed for IRS visibility, not for your benefit. They report gross proceeds, not true gains, and they do not understand intent. A transfer is not a sale, but the form doesn't care unless you correct it. And this is why panic is the worst possible reaction. When people see an inflated tax document, they either blindly accept it and overpay, or freak out, freeze, and miss deadlines. Both outcomes are avoidable if you understand what's happening before January 1st. Here's the uncomfortable truth: most people will learn about this after they get hit. By then, they're scrambling, arguing with CPAs who don't understand crypto, or worse, paying thousands more than legally required just to make it go away. That's not compliance, that's ignorance tax. This isn't about dodging taxes, this is about accurate reporting. The IRS allows you to correct cost basis, classify transfers properly, and reconcile records, but only if you have the data and the knowledge to do it. If you don't, the default assumption becomes you made more than you did. And remember, this is just the beginning. 2025 is the first year of this framework. 2026 adds cost basis reporting, more automation, more matching, more scrutiny. The system is tightening, not loosening. So if you own XRP, Bitcoin, NFTs, stablecoins, anything, this is part of the new reality. Regulation doesn't just affect price and adoption, it affects you personally at the tax level, whether you traded once or 1,000 times. The people who stay ahead of this aren't smarter, they're just earlier. They care enough to understand the rules instead of reacting to them. That's the warning, that's the message. And as always, this is not legal or tax advice, it's education. You should consult a qualified tax professional who understands digital assets and verify everything yourself. Do your own research, protect your capital. That's it for this one. Stay sharp, stay prepared, and I'll see you in the next breakdown.